Because tell me what you think the difference is between, I did comprehensive income, let's do it again. The whole idea of net income, comprehensive income, and then what's the difference between other comprehensive income, right? Okay, so did you get the picture of, you've got, it's really not going to do that, is it? We've got income from the income statement, right? Net income, that would be composed of all our revenues less our expenses, plus our gains less our losses, right, guys? Okay, you get net income, okay, after tax, okay. And then, but we've got this concept of comprehensive income, which obviously, I hope, to you, includes net income, but then it includes some other things called what? Other comprehensive income, and that gets added in with it. You guys with me on this? That's the way that works, okay? So what kind of things would be in other comprehensive income? If net income is revenues less expenses plus gains less losses, right? Including extraordinary ones, right? Okay? Including discontinued operations. What's in here?
Well, what's the gains and losses come from? Is that from like selling your assets?
Yeah, you might be selling land, building, or equipment, or an investment, right? Is what you're not in business to do, though. Remember, gains and losses, in the definition right there, what does it say? Peripheral or incidental, right? Peripheral to the operations. So your main operations is what you're in business to do. If you're Ford and you sell an automobile, well, that's sales and cost of goods sold for you. If you're UPS and you sell an automobile, what does it go? A gain or a loss, because you're not in business at UPS to sell automobiles. You don't produce automobiles and sell them, but Ford does. Got the difference? Okay, so if it's product to you, right, that you're selling, that you're in normal course of business, that would be revenues and expenses. Gains and losses would be a gain and loss on selling outside of ordinary operations. So yeah, fixed assets, investments in other companies, maybe that sort of thing. Refinancing debt too, though. Liabilities, you could refinance debt, have a gain or a loss on it, right? Refinancing bonds payable, retiring, bonds payable, you have a gain or loss on the retirement, right, guys? Can be rolling over your debt sometimes. That makes sense. But what? So does that help? Okay, on other comprehensive income, what?
Like your trading securities.
Okay, trading securities goes, well, trading securities does. Trading securities goes into the gains and losses that we recognize. But available for sale securities, yes. So available for sale, short-term and long-term go in here, okay? Short-term and long-term, okay? And then what else goes in there with other comprehensive income? Yeah, investments in affiliates, perhaps. No, nope. Investments in affiliates doesn't. Yeah, okay. But what else goes in here? Changes in currency, right? Currency gains and losses, okay? On foreign currency. So there's a few things. And then there's also some pension expenses running here, okay? Pension costs. These are political compromises that we didn't want to run through the income statement, so we put them in the other comprehensive income, because we want to revalue the assets. For instance, on available for sale securities, we want to revalue the asset to market value, but nobody wanted to hit the income statement with it. So there's the other comprehensive income. What's really critical about this other comprehensive income thing, you guys, is that most people don't understand it at all, and it can be huge. You got this equity section that nobody quite knows what it is. On your equity statement then, well, there are three ways that you can show this. You can show other comprehensive income either on the main income statement at the bottom, you can add it to it. Nobody does that because that's the whole idea. Nobody wanted to show it to people's income, so don't put it on that statement. You can do a separate statement where you start with net income and you work your way down to other comprehensive income. Some people do that. Or most people, what they do is they just put it on the equity statement. They add a column on the equity statement for other comprehensive income. Kind of hide it that way. Doesn't make the income statement. That's the idea.
What was the last one?
You can put it on a separate statement. You can put it on the equity statement. On the equity statement, you have preferred stock, additional paid in capital columns for each common stock, additional paid-in capital, retained earnings, right? And you have them in other comprehensive income category too. Okay? But, and then this total in other comprehensive income shows up on the balance sheet directly. It doesn't run through retained earnings. So that's more than we need right now at this point. You just need to know what it is at this point. Does that make sense? That later we're going to be doing that statement. Okay? So what's the big difference between, oh, by the way to describe comprehensive income, look at this. Changes in equity, on page 53, changes in equity, net assets of an entity during a period from transactions and other events and circumstances from non-owner sources. Oh, so it's everything that's not a transaction with the owners. That's all it is. Changes in equity that are not from what? Owner contributions or paying the dividend. Buying back their stock. So it includes all changes in equity during a period except those resulting from investments, owners, and distributions. Yeah, you got it. Okay? So you define it as what it's not. You got it? And it works. Okay? What's the big difference between revenues and gains? Your revenues. Inflows or other enhancements of assets of an entity or settlement of its liabilities are a combination of both during a period for delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing major or central operations. We said that last time, right? You might get cash, you might get accounts receivable, you get any asset. When you deliver goods or services, right? You debit the asset and credit revenues. But you also could get paid in advance, right? What do you do when you get paid in advance? Debit cash and credit what? Unearned revenue, or deferred revenue. Okay, so you credit unearned revenue. So what do you do now when you earn? Credit revenues, sales or revenues of some kind, and debit what? Unearned revenue. Yeah, and that's what the definition is the same thing, right? You're satisfying a liability, satisfying an obligation. Okay? So fine. How's that different than gains? Gains are increases in equity, net assets. Assets less liabilities is net assets, which is equity, right? It's right in the description there for equity above that residual interest rate. Okay? From peripheral or incidental transactions of entities, and not from their major ongoing operations, that's all. And from all other transactions and other events and circumstances affecting the entity, except those that result in revenues and investments by owners. So, again, you can define it by what it's not, right? Okay? But the first part of that definition is what you're going to do. What's the difference between expenses and losses? Same idea. Losses is going to be peripheral or incidental, but otherwise it's kind of the same thing, huh? Expenses are outflows or other using up of assets or incurrence of liabilities. What would be using up an asset?
Prepaid insurance.
And yeah, prepaid insurance. I buy the prepaid. Debit prepaid insurance, credit cash. What do I do as I use it? It becomes what? Expense. Debit insurance expense and credit prepaid insurance. Yeah, sure. Or you could, so any assets like that. Buildings, right? Depreciated, debt depreciation expense, credit accumulated depreciation, it's the same thing. But could you be incurring a liability instead? Sure, have your employees work for you, right? And pay them later. What would you do? Debit, expense, and credit, made payable. There you go, you're incurring a liability. So these definitions are just common sense. So don't memorize the definition separate from everything you already know. Use what you already know. Does that make sense? Okay. And there'll be a lot here. Okay. So let's do, no yelling. What is the overriding criterion for basic criteria for financial reporting? What is it? What's the overriding constraint and then the overriding for basic criteria? If you look on page 46 of that little chart. The big constraint is cost. It's really cost benefit, right? And the benefit exceeds the cost. Okay? What's the basic criterion for? You want to make sure the information is what? Decision usefulness, right? The financial statements are useful for making decisions. That's what it's all about. Okay? So when we go through these assumptions over page 54 and 55, keep that kind of stuff in mind. What are you trying to do? Okay? Decision usefulness. Economic entity assumption. What's the difference between an economic entity assumption and a legal liability? A legal entity. An economic entity and a legal entity. Separate legal entity.
What's that about?
What do you guys think? What's a separate entity? The owners are separate from the business. That's all it is. You keep the records of the owner separate from the records of the business. Okay? So what's a separate legal entity? Corporation. Still a separate entity. A separate legal entity is a corporation. Partnerships are an extension of the owners. They're not separate. They have no separate legal status. Right? That the Supreme Court decided a corporation of citizens or something. I don't know. Weird. Okay, it's a weird ruling. But the idea comes from separate legal entities. They have separate legal status. They pay taxes. And liability to the owners. The corporation has the liability. Right? Okay. But what do we mean by separate entity? Just that we keep their records separate. That's all. So if it's a partnership or a sole proprietorship, what do we do? It's just hard to own. Except, what do? We keep the business separate so you can tell what happened. What the business's assets are, business's liability, business's equity, separate from the owners, even though they're not separately owned. It's a real simple concept. That's all it's about. Economic entity assumption means the economic entity or economic activity can be identified with a particular unit of accountability, so the owners are separate from the entity. What's this going concern assumption? What's the going concern assumption?
Somebody will have a long life.
Yeah, which means, for practical purposes only, we're going to make them every year. So when you give them a financial statement, you value all the assets and the liabilities and therefore the equity as though it's a going concern. It's going to make it every year. If that were the case, imagine how would you value UPS's trucks and airplanes if you thought they were going broke next year? What are they worth? Liquidation value, not a lot. Right? They're worth a lot for them using it, but not worth much if they flooded the market with all their airplanes and trucks. Got the idea? So for any company, if they're not a going concern, you have a whole different issue, right? So it's an assumption we make they're a going concern. Now that doesn't mean we pretend they're a going concern if we think they're not. Right? It's implicit assumption. Okay? When you get an audit class, we'll actually make a determination of whether or not we think they're a going concern. And if we think they're not, we can't give them unqualified algorithm, right? Because we need to know they're going bankrupt if we think they are, right? We think they're not paying. So this is important. Okay? Monetary unit assumption. What's that about?
Denominator for all.
Yeah, money. Does money mean US dollars? No. There's all kinds of money. You ever heard the euro? Japanese yen? So there's all kinds of different currencies, right? All we're talking about is we use a type of currency in whatever country we're working in. There are fewer currencies now because of the euro, right? There used to be a lot more currencies. Every European country has its own currency. Now they just have one for Europe, right? Or supposed to be one. Okay. So again, monetary unit assumption. The monetary unit is relevant, simple, universally available, understandable, and useful. Sure, it's the money's the common denominator of everything. That's what we measure things. Periodicity, what's that? Or time period, what's that? Arbitrarily decide, right? That we're going to use years, quarters, and months, right? Does everything really break down that way very well? Well, yeah, kind of. For McDonald's, I think it's fine. McDonald's operating cycle is really, really short. We always say 1 year or one operating cycle, whichever is longer, right? Because how long is McDonald's operating cycle? From the time they buy their raw materials to when they deliver to the customer and get paid is really short time. But how about if you're building these bridges across the Ohio River that are being built? It's going to take a number of years, right? So what they'll do, or if you're building a skyscraper or something, what we'll do is we'll use percent of completion accounting. And we'll arbitrarily set up year by year by year by year we'll do financial statements. Make sense? That's because of periodicity. People want to have a financial statement every year. Your lenders do, your stockholders do. So we make a whole bunch of estimates in those situations. Otherwise, what would happen when you're building a bridge, you'd you have no revenues and no cost of goods sold until you finish the bridge, right? Can't deliver it. Earnings process isn't complete. So your loss would be equal to all your operating expenses every year. And then in the final year, when you deliver the product, you make a fortune, right? Because you don't have 1 year's operating expenses with all the revenues and all the costs of goods sold. So we get around that again, okay? But anyway, that's the idea of periodicity. Make sense? It's not a big deal. They're just not, okay? So, let's see, what else we got? Basic principles of accounting, measurement principles, okay? What are we trying to do? We're trying to measure value, of course, okay? Measure the dollar amount that we're going to have at balance sheet, income statement, and so on. See? Okay, so what do we got? Historical cost is what? Let's just, yeah, switch to paper. That's it. Is it real verifiable? Yeah, really verifiable, no problem. Okay. So, it's probably truthful and faithful representation is what we call that, right? Okay, it's pretty good. This is very relevant, usually, years later. No, not 1930, still my folks are historical costs, come on. Anyway, that's no major of value really at all. But it's still verifiable. So what we do is we really often choose between historical cost and fair value. And more we were moving to fair value. They talk about the fair value option. Companies can use fair value instead of historical cost if they want it. What's the problem with it? Look at the fair value hierarchy in that illustration 2.4 there. What happens? It might be real subjective what fair value is. I can decide that my house is worth $1 million. Why not? Hell, I wish it was. It's maybe worth $200,000. Really? I don't know what it's worth unless I do what? Sell it. Yeah, exactly right. That's the problem. So if there's too much subjectivity, it's a mess. So look at this. Level 1, observable inputs that reflect quoted prices for identical assets or liabilities in active markets. That's not very subjective. So when we're doing avail for sale securities or trading securities, what do we use? They're publicly traded. What would you use? The market value. We have a pretty good estimate at the end of the year what it was worth. If it's General Motors stock, we know what it's worth, right? Of course, that's just a picture of right then, but that's when you're doing your balance sheet. So we go ahead and we use fair value for that sort of thing. What about land you own? I don't know what it's worth. So what do we typically do? Historical cost. Now we were moving more and more towards using current values, and we kind of backed off of that. You know what did it to it? When the stock market went way down in the Bush's administration, right before Obama took over, right? We had this huge crash in stock market, right? Lost half the value. A whole bunch of companies had huge losses on their available for sale securities and trading securities, right? All of a sudden, nobody likes their value. When things are going good, and prices are going up and up and up, they're oh yeah, what's their value? We ought to be able to show those gains on our income statement, right? Are they real gains? I don't know. They only get really sold, right? They're not realized. But did your wealth change? I mentioned you guys, I'm twice as rich as I was when Obama took over, more than that, right? The stock market's more than doubled, right? Plus, put more in, of course. But over that period of time, wow, it's not crazy. Am I really that rich? I don't know, right? Who knows what it's worth, right? It's really subjective, isn't it, in a strange way. So then to level 2 there, they say inputs other than quoted prices, including level 1 that are observable for the asset or liability either directly or through other observable data. So that's not as good as level 1, but not bad. And then 3, unobservable inputs, the company's own data and assumptions, those are more, right? So fair value might be a real good measure or a real weak measure is the point they're trying to make. Historical cost is always verifiable, but it might not mean much, right? In terms of relevance. Revenue recognition. What's the deal with revenue recognition? What do you need to do to recognize revenue? I am going to recognize revenue when I earn it. When the earnings process is substantially complete, right? There's not anything else left to do, right? Basically. Except I might have a warranty, but they don't have the right to return. They have the right to return the product. I'm not going to have revenue, okay? So there might be warranty left, though, so that's fine. Okay, but the earnings process is substantially complete. You deliver the goods and services, basically, is what it counts. You completed that process. And then the other thing is, so that would be to earn. Then you have realized or realizable. What does realized mean, you guys? I said recognized versus realized. the other day. Recognizes what?
When you actually get that.
Which one is that? When you actually get the cash, what is that? Recognize or realize? That's realize. Realize is getting the money. When you actually get paid, you realize the revenue. When you actually pay the expense, you realize the expense, right? Recognize is different. What is recognize? That's at the point that you've earned it,
Yeah.
right? Yeah, the point you've earned it, you recognize. That means record the sale, right? Recognize is put in the financial statement. Realize means to pay, okay? Same with expenses. Expense recognition, I recognize the expense when I incur the expense trying to generate revenues, right? Everybody good with this? Okay, it realizes that I actually pay the expense. Now, in order to recognize revenue, it must be earned and either realized, which means you get paid, or realizable, which means what? You're gonna get paid. That's it. You got it. Okay? So what's an allowance for doubtful accounts for in bad debt expense? You're estimating the portion you're never gonna get paid, right? And you take that out of your income with the bad debt expense, and you take it out of the receivable with the allowance. Does that make sense? Okay? So, anyway, yeah, so they talk about revenue recognition principles, they talk about expense, and they'll be more in depth as we go through the course and through the next couple classes. Expense recognition principle, also kind of referred to, not as much, but used to be more formally referred to as this, but now it's still, everybody still does it. If you look at the footnote number 18 on page 59, this approach is commonly referred to as the matching principle. We match revenues and expenses, right? Matching principle. So the expense recognition principle is also called a matching principle. We'll probably use expense recognition principle because it's a new terminology. Okay? So, yeah, I recognize the revenue when I earn it. I recognize the expenses when I incur them in an attempt to generate revenues. So something like the cost of goods sold, as just shown the kid earlier, cost of goods sold, you specifically identify, right, that cost of the inventory you gave to your customer, huh? You can specifically identify that with the sale. So a lot of expenses are, okay, I incur them in order to get the sale right at that time. Sales commissions would be another one, right? Delivery cost would be another one. Real easy to identify what revenues those expenses go with. How about something like a sales salary? They know when you got the revenues for a salary.
Product and period cost, right?
Yeah, you got it. Product costs, very good. Product costs are easily identifiable with revenues, right? Period costs is kind of tough. Although sales commission is not a product cost, but it's still easily identifiable. So, but that's not a bad thing to do. And what about advertising campaign? You know when you get the benefit of your advertising campaign? Or research and development. You know when you get the benefit? Now what do? You expense it in the period that you specify, right? That's it. Whenever they did the ad campaign for you, you expense it. You don't know when you can get the benefit. You have to do that. Okay? You guys good? Same with research and development. Okay, we don't know if we're ever going to get the benefit, so to be conservative, we go ahead and record that we incur the cost. That makes sense? Okay, and then the other thing we do is a systematic allocation of the cost. What would be a systematic allocation of costs? I buy a building and I use it up over time. What do? Depreciate it over time using some systematic rational allocation method. Right? Does that make sense? Okay. Double defining balance, maybe straight line, right? However you think the assets can be used up. That makes sense? Okay. So they talk about that stuff. Okay. And there they are, over on page 60 in the box. There you got your product cost, your period cost, direct relationships, no direct relationships. If there's a direct relationship, match it up. If there isn't, expense it as incurred. Okay, now full disclosure principle. This is a lot of what the notes are about. Supplementary information statements, they talk about those, right? Okay? I'm not really talking about anything that's not in the book anymore. Right? But it's kind of helpful probably to talk about it a little, don't you think? Clarify a little bit. But you can pound through this book. Oh, the PowerPoints, I was going to put them up there today, but it's not working. You can pull up those PowerPoints. They're out there, right? And move them. But pull up those PowerPoints and go through them. And every time you get ready for this quiz, if they have a description you don't understand, go back to the book and look at it. Does that make sense? But if you look and say, oh yeah, I got that. They're real condensed. They're real short. in the PowerPoints, but they're a nice basis for discussion, or a nice basis for sort of jogging your mind. You look at, okay, I don't know what they're talking about, right? Then you go back and read that section of the book. Also, these yellow boxes, I'm not going to put you specifically, of course, on what company did what or something, but they really help with understanding if you read those and think about it. I read everything else first and then come back and look at those after I sort of had a grasp on what all the ideas were and what all the concepts are. And then read it, oh yeah, there's a real life example, right? A real life application. Okay? They're pretty good. Anyway, in the full disclosure, what do we want? What should we have? What does full disclosure mean? It says in deciding on page 60 there. In deciding what information to report, companies follow the general practice of providing information that is of sufficient importance to influence the judgment and decisions of an informed user. Okay, so what's the deal? These trade-offs strive for sufficient detail to disclose matters that make a difference to users, sufficient condensation to make the information understandable. I want it to be understandable, and I want it to be useful for making decisions. And when I'm deciding whether or not to give somebody a piece of information in the notes of the financial statements, is it going to change the decisions? Is it going to have an impact on decisions? If yes, put it in. If no, leave it out. Materiality, is it big enough to impact the decision? If no, it's not material. Yes, it is. Right? That's kind of the threshold. And notice it says reasonably informed. If somebody knows absolutely nothing about it, they don't know what an asset is, they don't know what a liability is, I mean, they just know nothing. They're not a user you have to worry about. A reasonably informed user. Now, they don't have to be a CPA, obviously. They don't even have to have had an accounting class, but they have to understand business enough to actually read a statement. Okay? Otherwise, there's no way to fulfill this, right? You can't explain what an asset is when you do financial statements. You don't have to. Okay? You would want it. Also, anyway, the numbers like that. Cost constraint, and here they're talking about the cost benefit thing, right? On page 61. So, it's the cost benefit in the situation. What's the cost to prepare some information, and what's the benefit of that information? I was really popular with staff of my clients, the accounting staff, when I was in public accounting. Because when I get a new engagement, the first thing I do is I go out and look at all their reports. What do you have? What do you do? One of the very first things. What do you guys do? And then I look for overlap between the reports. And they're almost always have. Two people are preparing exactly the same information. And everybody's too busy. Nobody can get their job done. Everybody's too busy, but they're doing redundant things, right? They're not putting information together in one place. Databases have helped a lot with that over the years, but still, it's still just all kinds of work for no reason. So what I do is I start suggesting, well, if nobody's using this report, let's get rid of it. So you'd be preparing a whole bunch of reports, giving the manager, and I go around to the manager and say, what do you do with that report? Oh, that one's not for me, I just file it. Do you ever look at it? No. Or I round file it. I get a copy of it. Well, now you get a copy electronically, it's released, you throw it away, you just delete it, right? Or you can save it in a rec file somewhere forever and never look at it either way, right? Okay? So why are you paying somebody to do this? Besides that, why would you be overworking people, right? Having to work overtime and stuff and under all kinds of pressure when you don't use the information. Don't ever have somebody prepare information for you. If you go into corporate, don't even public, don't have anybody ever prepare a document for you nobody's going to use. That's just insane. Why would you do that? Don't put in internal controls that aren't going to use. And don't do it. It's not going to have a material impact on things. Don't do it. Okay? Don't just do it because you're an accountant and you like to do something. Right? Seems cool at the time or something. Don't do that. So what I do is I get rid of a whole lot of those. And then sometimes the employees will say, well, I'm going to get fired. No, I have all kinds of other things you guys aren't doing that you should be doing. Right? But he's really nice about this additional information. And the manager says, yeah, it'd be nice to have it, we don't have anybody to do it. And you do. I guess two people doing the same job. Let's not one of them do this, the other one keep doing the other stuff. So use that, you guys. So this cost benefit is really important. You know, I'm not gonna do work that doesn't, where it's not generating either more cost savings or more revenues or, you know, giving people better information or something. Gotta be doing something. Okay, so. 45 minutes. Do you have any idea? Let's take a look on, in fact, let's do these, on the very last page of the chapter, page 62. Could I just think of the questions I could give relating to that upside down pyramid there? What do you think I might ask?
What's the difference between relevance and faithful representation?
That'd be good. Or define each. Tell me what the differences between them, define, that's great. Define, and in that you define each of them, wouldn't you? Okay, and make sure when you define them, that you include what in these notes? Three, yeah. And discuss them a little bit. I don't mean writing 5 pages of stuff, but, you know, a long paragraph, maybe, you know, a couple short paragraphs. So what's critical on relevance and faithful representation? Relevance, for something to be relevant, what should it be? I mean, if you could look at this table here, this chart, this upside down pyramid, whatever, if you could look at that and look at each one of those items on there, I know what that is. I know it because I can write down the definition of that, right? I've got this thing fired. Okay. What do you need to write down for relevance? It's relevant if it gives you what? It's predicting value. It's useful for predicting what's going to happen, right? That's what financial statements are supposed to do. What else? Confirmatory value, which is also used to be called feedback value. I don't like that better too, but I like confirmatory value. What's that? I get feedback. I get a budget, get a plan, right? And now I've got feedback about what really did happen. So I can evaluate managers, right? I can see how good my predictions of the future were in the past, that sort of thing, right? Okay. And then what's the other one? Materiality. Yeah, if it's not material, it's not particularly relevant, right? It's not big enough to be relevant. Why bother? Okay. What if it's faithful representation? It's got to be the truth if it's faithfully representing what's going on, right? So what really happened? It's true. Okay, whatever that is. Okay, so what do we got? Completeness. Everything there that needs to be there. What if you put too much in? What if you disclose too much? I mean, read back to this fair disclosure idea, right? Full disclosure, I'm sorry, full disclosure. What happens if you give people too much information? Information overload, and now you confuse them, it's not understandable, right? That wouldn't be full disclosure. Full disclosure is not telling everybody everything, it's telling them what they need to know. So you're making this judgment call, how much information should I put in the notes? How much should I put on the face of the statement? How big a number is material or isn't material, right? So full disclosure is about making it useful, right, and understandable, I think it's that, right? You getting the idea on this? These chapters aren't very long, but they're packed, aren't they? There's really a lot in here. Okay, I do want you to know it, no doubt about it. They will in the CPA exam too. Okay, and then neutral, what's the idea with that?
It's not favoring.
Not biased.
It's not biased, it's not fair. Why do you use outside independent auditors? They're not biased, they're independent by definition, right? If you're working for a company, you might have a bias, even unintentional. You know, you want somebody to be successful. And you have to fight that if you're an outside auditor too. You want your clients to be successful? Yes. You want your clients to like you? You're a human being, right? Yes, you do. You sometimes have to give bad news. No, that disclosure is not okay. No, I don't think your income is that. I think your allowance for doubtful accounts is 100,000 and it needs to be 400,000. And that's 300,000 less net income when you bump up the allowance, right? And they've only got 200,000 net income now, you're going to make it negative 100. I mean, you got to be tough, right? And you have to really not be biased, right? Be neutral, okay? So this is really critical, isn't it? You want the information to be neutral. You know, it's not a ad. We're not marketing people, right? We're not making the Big Mac look like something it isn't. When you look at an ad, a picture of a Big Mac in an ad, right? You go to McDonald's, make the picture of the Big Mac there. It doesn't look like the one they give you, does it? That's because they built that one perfectly, they worked for hours and hours and hours, and then they photoshopped the picture after they took it, right? To make any imperfections be gone, right? You know, we know it's an ad, we know a Big Mac doesn't look like that, we've had a Big Mac before, we know what it is, right? It's okay, they can do that, we expect it, don't we? Right? That's not what financial statements are for, and you need to constantly remind yourself, remind your boss, remind your clients, right? This isn't an ad, you guys, and then they'll laugh and say, yeah, you're right, they're trying to make it look too good, and I put a good spin on everything. No, you just want to tell the truth, what it is. And the argument for your boss to convince them that they really don't want to misstate the financial statements by bias, unintentionally, or this is, you know, we'll make it up next year, or, you know, all kinds of rationalizations for it, right? We don't want to misstate those financial statements even a little, because if we get caught, the bottom's going to fall out on our stock price. Because people are going to think we lied to them. And if you thought, if you give me some of your money, and I'm investing it, I'm using it, and I lied to you about what I did with it, about how things are going, what do you want? I want my money. I'm going to give it to somebody I can trust. This is really critical. So tell your bosses, you know, you just can't do it. No, I can't debit accounts receivable and credit sales for sales we sold January 1st and our year ends December 31st. I just can't do it. I'm not doing it. I won't go there. I'm not going to compromise my integrity. And they'll say, oh, we're not compromising integrity. We know we have a sale. Yeah, but it's next year, it's not this year. That's not that. You can't do that. You're telling what you earned this year, not what you earned next year. Come on. You can't borrow from next year. Right? You can't artificially increase revenues. You can't artificially reduce expenses. They're what they were. Well, I love this phrase, find me some, right? Find me some more net income. You have to generate net income during the year. You can't wait till next year when you're preparing the financial statements and find some. Now, you might find errors, true, but be careful. If you're working inside the company, or even if you're coming in outside, as a consultant trying to help an auditor, maybe even trying, don't do a selective search. Don't look for revenues that are not reported without looking for revenues that are overstated, right? If there are millions of transactions and you find some sales and you get properly reported and they're understated, sure. But what do you bet you find just about as many where they reported too much and you should take it out? So if you don't do a selective search, it's probably going to wash to nothing if they have good internal controls, right? And you find all the errors, you're going to offset it. Same with expenses. Can you find some expenses that are too high? Sure. Don't do a selective search. You only look for the ones that are too high, because then you'll never find the ones that are too low, and you won't increase those. And you will unintentionally overstate their income. And that'll come back to bite you the next year. That makes sense. Plus, can a financial statement user really tell whether or not you did it on purpose or it was an accident? Just a bias search. So maintain. As an outside independent auditor, you are independent, not biased. As an internal accountant working for the company, either as a financial accountant or as an internal auditor, either one. Right? When you're inside, maintain your objectivity. So you can't be independent if you work for the company, but you maintain your objectivity. Should be just about the same thing in my view. Yeah, you want to walk away from your job or get fired. You're not going along. You really need to maintain your professionalism, right? Your career. So, anyway. So, this idea of neutrality is really important. And it's free fair, of course, in all states, right? Or, all states. Right? Okay. So, I don't know. What else we talked about? Most of these things, I think. Without looking at it, give me the objective of financial reporting. Yeah.
Provide information that is useful to present and potential equity investors.
Mm-hmm. And creditors, other users.
In a timely manner.
What's that?
In a timely manner, right?
In a timely manner, I like that, okay? In their capacity as capital providers, they don't need to put timely manner there, but that's all right. You're right. Okay. So, yeah, it's gotta be timely or it's not what?
Useful.
Not useful, yeah. So useful information. Yeah, sure. And they just beat that to death throughout the chapter, I think. A really nice discussion. You sure look at the PowerPoint and stuff, they really do a nice job of it in the PowerPoint. Maybe I use that. When you had a group comes in on Tuesday, I assume you guys are gonna do that too, I'm just gonna try to say Thursday, it's the same thing. I'll see what the PowerPoint up there and discuss through it too, so for everybody else, so do it on your own, right? Sure you do, sure you look at. But each of these definitions are pretty well laid out. By the way, all this is just copied out of the concept statement, right? This conceptual framework, and there aren't very many of them, right? Yeah, I told you don't even memorize the numbers and the names of those. The questions don't look that way. They'll give you an idea what it is first. Oh, this is good on page 48. Quantitative versus and qualitative factors when determining an item is material. For materiality, what is material? An item that does what? Material.
Makes a difference.
Makes a difference in what? The decision of a
Investor.
informed financial statement user, yeah, which might be an investor, might be a creditor, yeah. Okay, like your current stockholder, potential stockholder. Okay, so it would make a difference to an informed user of the statements. Okay, then it's material. If not, it's material. I love this concept of materiality. It's great. With materiality, what does it do for me? If it's not material, then I do any work. Done. Don't mess with it. It's material and ownership. Okay, so I love materiality. Another one is conservatism. Everything's kind of conservative. What does conservatism mean?
Not as much as kind of,
What's that?
like doing as much, I guess, kind of, with like,
No, that's cost benefit. That'd be cost benefit. Don't be thinking
What's there, is it like not to overstate your revenues and
You got it.
understate your?
You got it. We think about the balance sheet and the income statement. Now, I'm not going to intentionally report something wrong. I'm going to get the best estimate I can for everything, of course, right? So I'm not going to intentionally misstate anything. But here's the deal. If I'm choosing between competing estimates, right? Say two estimates are equally good, right? When you're deciding which estimate to take, you would take the one that would tend to make assets less. You're very careful, like you said it just right. You're very careful not to overstate assets, right? And what that does, if you are careful to not overstate assets, that'll make sure you don't overstate your wealth, right? Everything else all equal, right? And then we also are very careful not to understate our liabilities. I take the one that made my liabilities higher, right? That's conservative. Only if I'm choosing between competing estimates, right? And what would that do? That's also going to make equity be a smaller number, right? I'm very careful not to overstate my equity, what we're really saying here, isn't it? On revenues, you're exactly right. On revenues, what's the deal? If I'm going to choose between competing estimates, I'll take the lower one, which makes net income less, which does what? Makes equity a lower number, right? Now, I'm not intentionally misstating anything. Don't get that impression in all those areas. It looks like we are, right? We're just choosing between competing estimates. Same on expenses. Which one would you take? The higher one, the higher estimate, which would make net income less, make equity less. You see a common thread there? And but when you're writing the answer, be careful. You don't imply that you would intentionally understate equity or understate income. Ridiculous. Nobody do that, right? You don't intentionally mistake things. Just when you're choosing among competing estimates, you'll take the one that makes your equity less all over the place. Okay? So that's a good thing to have down too. Good stuff. Do you have anything else? Did you you have any questions? Because we killed the hour anyway. Can always kill an hour, unfortunately, stuff in. This is a weird place to get ready. It's not everything by that.
But there's numerous problems in that and backed up quite a bit too.
Nah, that was a good thing. The multiple choice are good, right? And then, oh, there are a couple multiple choice things. And I like little fill-in things, like I'll give you a description. These are kind of tough. And there's these problems are useful. There's something like this. It gives you a little scenario and it says, what principle? Is it measurement? Is it matching? Is it revenue recommendation? What is it? Right? And then you answer, right? Those kinds of things. You know what I mean? Like that type of thing would be good. Okay. Or, which principle is it? Which assumption is it? Those are kind of good. With a fair idea, know what's going on. So it won't be just recall. It'll also be application. There's some of those. And then the multiple choice ones do that too. I mentioned, I think, in class that, we could do relevance, which among these four answer stems relate to relevance. And I could put verifiability, consistency, feedback value, and usefulness or understandability or something. I mean, which one would you pick? That's a feedback value further back there. Again, right? Further back. So I could have just one of those. Those are easy. After you really understand this stuff, those kinds of questions are easy. And they're very common, so you can get them, so it's okay. Right? I'll use some of those stuff. It'll be somewhere in here. I don't know. I have to get a quiz yet. Quiz will be done one way, the test will be done another, the final will be done another. So you get it all. That makes it fun. So don't prepare for anything. Okay. Thanks for waiting on that. Maybe you got something, huh? So you think for people who weren't here, that would be worth saving? To listen to? I guess they couldn't make it either one of them.